Welcome to the Family Office Podcast, powered by FamilyOffices.com.
Hello, this is Richard Wilson from the Family Office Club, and we have with us here today Michael Connor. Michael has worked for a couple of different $1 billion plus single-family offices. He's worked for some well-known families whose names that you would recognize, and I think that a lot of professionals who are trying to work in the family office space are trying to figure out, what they need to know, what they need to be an expert in and able to manage the portfolios or manage the operations of a large single-family office. And it's such a cloudy, non-transparent industry, and especially it was 5 or 10 years ago, that we love doing these types of interviews just so we can clean stuff up a little bit and just provide at least one granular example or case study on how one executive has navigated the industry, what he's learned along the way, and just make it a little bit less confusing than it needs to be. And I think this is really helpful for those that have just came into a lot of liquidity through selling a business or taking a company public, or an executive who's working at an endowment fund right now and they'd really like to be working for a family office, they think. So hopefully everyone enjoys this interview with Michael. He's spoken at one of our conferences before. I first met him when I was working on the sell side. I called on him. I believe I was representing a global macro hedge fund, and we've met in person several times, both at other family office conferences as well as my own, as well as talking about investments when I was in the Denver area at the time on a road trip. So definitely it's been great to keep in touch, Michael, and I'm looking forward to interviewing here today.
Okay, great. Glad to be here and get a chance to speak with you.
Could you share just a little bit more, and it's completely up to you on the level of detail you want to share. There's no pressure at all. The values from your experience and the insights you can provide. You don't have to disclose any names at all. But if you could share just a little bit more on your background, the type of roles that you've played at least, I think that might be helpful to understand your perspective.
Okay, sure. As you're probably aware, I didn't set out when I started my career to be working in the family office space. I think when I first started, it didn't really exist to the degree that it exists today. So I have an accounting background as far as my undergraduate work in college. When I left there, I am from New York, so I went into New York City, worked in a few Wall Street firms for about 12 years in financial roles, eventually becoming a controller within the financial services industry, worked for various firms, learned a lot about the capital markets, which is what I wanted to accomplish by going in that direction with my career. Joined my first startup company in 1996. It was in the technology space. Also in New York City, it was in Silicon Alley, so when the alley there was in its infancy. Unfortunately, there was explosive growth, but the company was not successful, and I got to wind that company down. And from there, launched my career into the venture capital industry. I had met two gentlemen, Fred Wilson and Jerry Colonna, who had started a venture capital firm in New York called Flatiron Partners. Fred Wilson is the Fred Wilson of Union Square Ventures today. So he's been an early investor in companies such as Twitter and Zynga and Foursquare and Delicious and Tumblr. So my time with Fred and Jerry from 1997 through 2002 was just a great experience in my career, and I also learned a lot, probably from today, someone who's one of the top 10 venture capitalists in the country. But after 9/11 and the tech wreck, I left Flatiron Partners and joined my first family office out in Seattle. The company's Vulcan. It's Paul Allen's management company and family office. I joined there as CFO for his investment group, eventually becoming treasurer for everything that Vulcan touched in regards to Mr. Allen and his family. So not only the business aspects on the private equity operating company side, but also real estate, his philanthropic endeavors, as well as the other special projects and residences and various assets that Mr. Allen owned. I was with him for about 7 years. I left Vulcan in the end of 2008 during the correction in the markets back in 2008, and in 2009 I joined a family office here in Denver called Consolidated Investment Group. I joined as the chief investment officer. The family members there were the co-founders of the Hot Pockets brand, which they sold to Nestle back in 2001, and started their own family office operation. I had been the CIO for Consolidated for about 5 years. I've recently left there and have started consulting with various family offices and family businesses, either to help them build out a family office platform, act as maybe an outsourced CIO, or in my most recent case, I'm working with a family who were the founders of Baby Einstein, which they sold to Disney back in 2001. I'm just helping them today with their latest business idea, helping them establish that business, come up with the financial strategy around it, and also working with them out in the capital markets, in the VC community in particular, in raising capital, because they do want to take a slightly different approach. They don't want to just invest all their capital in the business. They also want to bring in some smart outside money from good financial investors to help stand that business up and grow it. And that's where I am today.
Sure. Great. Thanks for sharing all that. I know that the industry is sometimes people use the term family office in flexible ways, and you've obviously worked for some well-recognized families that have very large portfolios. There's no question that they were large enough to need a formal, kind of full-fledged single-family office. So let's jump right into some of the questions here. All of our events, family offices want to talk about direct investments. On some of the deals that we work on, some of our clients, we compete against other family office direct investors. So there are family offices making direct investments all of the time. But compared to how much it's talked about, not many families are actually acquiring more than one company every 2 or 3 years, in my experience. So I'm wondering, from your perspective, what are some of the top 2 or 3 reasons why you believe families maybe aren't closing very many deals compared to like private equity funds, for example?
Right. From my perspective, and it's interesting because I worked in 2 different family offices. One, Vulcan, was very acquisitive and very active because they had a fully built-out platform that we had built out, and a principal, Mr. Allen, who is very forward-thinking and a risk-taker, and was willing to take risk for various businesses or opportunities that he thought would offer a lot of upside. Then my most recent family office, we had built out a direct investment platform there, but it's a very different approach, and is probably the reason why you see a lot of families out there talking about it, but they aren't moving as quickly in regards to acquiring businesses, like you had said, maybe 1 or 2 businesses a year. And some of those reasons are, number one, I think for family offices just getting to the business, they don't have a set timeline as far as, like a PE fund. PE fund has, typically, let's call it a 5-year investment period, and then a 5-year harvest period, and then they could extend it out 1 or 2 years if they run into problems harvesting their investments. For families, they don't. It's not like, I collected $100 million today or $500 million today, and I have to deploy this capital in the next 5 years. They don't have that timeline that they butt up against as far as deploying capital. So they're very methodical in their approach. So that's number one. Number two, I think the staffing in family offices is not as heavy as it is in PE firms. So it's not like they can vet as many deals as a PE firm and find as many that are intriguing to them that they want to move forward with and invest in. And some, like in the last shop I was at, only gravitate towards what they know. The principal, was an entrepreneur, very successful in their own right, and they want to go out and make these direct investments, but they know one thing, and they know that one thing really, really well. Even though they can apply a lot of the business skills across, various different verticals, they feel comfortable in one area and want to and focus in that area, and that severely limits the available opportunities for them, right? Because it becomes very, very focused, laser focused. And if they do decide that they want to move outside of that comfort zone, they want to learn about what it is they're doing. Right? If it's a totally new business sector that they're getting involved in, they want to understand it because their mindset's very different from a PE firm. While a PE firm wants to understand what it is they're investing in and what the opportunity is, they're not operators, so they don't think about it as an operator. Whereas a family office entrepreneur or principal who was a former entrepreneur looks at a business, they compare it to their prior business experience as an operator, right? And want to get comfortable with it, and they're looking for a perfect fit. So those type of dynamics that go on, especially for a family office that's just starting to get into the space, could be some of the reasons why they don't move as fast as PE firms or other large family offices that have been in the space for a while and have been doing it for many, many years and have built out staff and some intellectual capital in-house to understand what it is they're doing and how they want to do it.
Right. And do you think that it's true, for the families you've worked with and the other ones you've met with, like at events and your network there in Colorado, that most of these families do invest for, a 20, 30, multi-generational time horizon, or do you think that it's a little bit shorter mindset with most of their investments?
Mm-hmm. I don't think when they look at deals or we had looked at deals that you take that 20 to 30-year time perspective into consideration. I think really the way that they think about it and the way that folks in general should think about it is that it's more about patient capital for them. What does that mean exactly, right? So going back to the PE example, that capital is not as patient because they have timelines they have to adhere to, right? So if you're in year 5 of your investment period as a PE firm, you got to figure out how to exit this thing in the next 5 or 6 years, right? So that's not very patient. And if there are downturns in the economy or a particular sector of the economy, that's going to impact timing on exit as well as the value you can get from that. I think for a family office, the patient part comes into play where there is no set harvest period or investment period, and while they don't need to harvest capital within, let's call it a 7 to 10 year time frame, they'll look at it within that time frame because they want to know what that potential return is on investment, number one. What am I going to get in 7 years and 10 years? Because, as you know, unless you have a business that's really growing exponentially, eventually your IRR goes down the longer you hold it. Right. So I think family offices do look at it with that same 7 to 10 year time horizon, but if there is a downturn in year 10 or the sector slows down, they don't have to sell it, right? They can hold on to it those few extra years to wait for a better time period or to get the business on the right trajectory again before they sell it.
Sure.
But the other problem with a 20, 30-year time horizon is, is the business I'm investing in, is it going to stand the test of time over 20 to 30 years? And, especially today that becomes really relevant because things change so quickly. Unless you acquire a business that there's always going to be a demand for. Example, maybe table salt, right? There's always going to be a demand for that. It's not going to grow, but it's going to continually throw off cash flow, for the foreseeable future, right? It will stand the test of time unless dietary tastes change. Whereas, investing in some other business, like, a buggy whip company, for example, or today's example of what a buggy whip company would be, you're not sure if it's going to be around in 20 or 30 years.
Right.
So I do think they're not different from other institutional investors as far as timeline. It's just that they have a bit more flexibility around when they exit the business, and then can make a determination, down the line as to whether or not it's a business that they want to keep and it ends up being an engine of cash flow for other things that they want to do, or it makes sense to exit it.
Okay. And a lot of family offices are trying to figure out how they need to staff up to get enough deal flow, look at enough deals, and have the analysts to actually be able to dig into and conduct due diligence on deals, and then to manage the deals post-acquisition. So if let's say a $2 billion single-family office came to you, and so they want to acquire two businesses. They want to write $20 to $40 million checks each time. They want to acquire two businesses a year for the next 5 years on average to create kind of a platform business within one or two different industries. Let's say two different industries. Don't make it too simple. And they want to be majority owners of those businesses. What size of team do you think they should build out internally? Of course, each time you acquire a business, the operational partner and the operational team will need to, come with that business or be installed. But essentially, as a single-family office, if they came to you and said, what should this team look like, Michael, what do you think would be a reasonable number of professionals to handle those transactions?
Okay. It's a two-pronged answer. I think the first question I would ask them is, what's going to be your approach or strategy that you want to use once you acquire these companies? So, what type of companies are you looking for? The vertical question already answered. Maybe go into two different verticals, but beyond that, are you buying companies that are going to need a lot of hands-on help? Right? Is the company in some sort of financial distress and they need to work it out? And or does the management team need to be swapped out just because they're older, they're tired, they want to retire? Does the business need re-engineering, like let's say maybe more Six Sigma type processes need to be integrated into what they do if it's some sort of a manufacturing business? So you'd have to figure out those things first, because what I just spoke about, those type of things are going to require more internal staff rather than less. Right. If they're going to go in and buy a business where, let's say it's a younger company and it's growing, you don't need to be as hands-on yet. You'll be involved in hiring decisions and setting strategy, but that's not going to be as roll up your sleeves as some of these other things I just spoke about. But that aside, I think on the deal sourcing, which is probably the most important thing you need to build out, I think you should start with at least two people with some experience in the industry. At the one firm I was at, when we built out the platform, the principal wanted to get his family members involved and thought having them start on the deal sourcing side would be a good learning experience for them. And while it really slowed the process down a lot because they had never done it before. And I was doing a lot of mentoring of them and teaching and educating, and they were spending a lot of time themselves going out there in the marketplace, getting educated and learning, and then just getting the word out that here we are. We're looking to do direct deals within direct private equity. Here's who we are, and here's why we'd be a good partner to partner with. in what it is we do, or a good acquirer because here's how we can add value. And, I mean, that alone took a year because the folks weren't already plugged in. So the first thing I would advise is on the deal sourcing side, I would start with a team of two. At least one of those people are already plugged in and have experience, so that it's, that you just flick a switch and they can go out there and they know what channels to go into. They already have the relationships, and now it's more educating the marketplace about who you are as a single-family office / private equity or venture capital type investor. I think that would speed up the process a lot. On the diligence side, you're going to want to have someone in-house. A lot of it can be outsourced. Right? The legal diligence can be outsourced. Some of the financial stuff, if you're willing to spend the money working with an outside accounting firm, a Deloitte, or maybe a large regional firm that has experience, you can outsource a bit of that. But you do want someone in-house who is, the third eye, looking at what it is they do, because even though these folks are very good at what it is they do, you as the investor have a slightly different perspective, and your level of diligence, quite honestly, will be different. You may ask questions that they're not going to ask, so you need at least one person with some diligence experience to play quarterback, if nothing else, working with an outsourced diligence team. You're going to want, ideally, the head of the group, so let's call it a managing director type, for lack of a better word, who's just going to oversee every aspect of it, right? He's going to want to oversee, the sourcing, make sure that's done appropriately, understand the diligence aspect of it, understand the management team of the company that's going to be acquired, and make determinations around who do I need to replace, if any, and who are key to the business going forward. And then if you are going to be a more hands-on type person, principal, what's the principal skill sets, and are they going to add value to it, and will they be involved in, once the company is acquired, sharing that intellectual capital they have. For example, like you had mentioned, let's say you go into a vertical where you have deep expertise because you have been an entrepreneur or business owner in that area. Is the principal going to be actively involved there? And if not, do you need to bring in maybe a professional that has some operating experience within that sector to be part of this direct investment team? And then you need initially one analyst to take a look at the business and dissect it every which way possible to really understand what is the business, what's the opportunity, talk with the rest of the team on what's going to be the game plan once we acquire this company, so that once the company's acquired, you're not spending a lot of time spinning wheels figuring out what to do. If you have that all figured out prior to acquisition and prior to closing, you can just be off to the races, beginning day one. So that's what I would start with. And again, depending on the strategy that you have, you can add to that team, but that would probably be the base that I'd start with.
Right. Okay. Great. Yeah. Lots of helpful advice in there. You answered 3 or 4 additional questions we could have asked about that, and your advice about having the plan fully in place before the acquisition, I found can actually help with the due diligence as well. We tried to, through Wilson Holding Company, acquire a business that was basically a distressed business, and it had just been ignored basically by the current owner. We've slowly gone downhill. When we were doing the research on how we were going to ramp it up, we realized that their data source for the business that they were running, they were actually breaking numerous federal laws on how they were acquiring the data. So as we tried to look at how we could improve their data source, we realized that technically the way they were operating wasn't even legal, and that's probably why they had ignored the business and were just trying to sell it as a distressed asset. So it's kind of an extreme example, but if we hadn't really dug into how we're going to triple this business in the next 6 months, we might not have looked at all the angles that we looked at. And then you also know that we work on deals with several families. We have contracts in place with 7 different clients now, where we help them originate deals. So I'm interested in your experience here when you've gotten deals that were the best quality deals, let's say, quote unquote off market. Everybody uses the word proprietary nowadays, but the best deals quality wise that came to you throughout your career, were those typically through investment bankers, business brokers? Were they through other family offices? Were they through a network of some type, like an attorney network or CPA network? Or how did you source those deals? How did your team get those deals?
That's a good question. The best deal that I have seen come into our shop, and this was at Vulcan, was more accidental than anything else. Our team was out there looking for potential deals, and someone had heard that we were looking to do deals, and there was this company in the energy space that was looking for a partner, and they had very specific needs, changing the structure of that organization from more of a LLC, S-Corp type structure into a C-Corp structure, and there were some tax issues that they needed to get resolved. And in a private equity shop, going back to what I'd said before, their limitations on timing and what they could do really wasn't the right partner investor for them. And they heard that, well, here's a large single-family office with very deep pockets. Let's approach them. So that deal came to us accidentally, and we were able to do it, A, because of the patient capital aspect of it and our willingness to look into a structure that would be tax advantageous both to the owners of that business and then, to ourselves as well. And it ended up being the best investment that we had done as a direct private equity investment. It was over a 10x return within maybe six years or so. And there's one that you just stumbled over by accident.
Right.
I find that some of the one, let's call them lower middle market type deals that have come across our desk, a lot of them, they'll come from business brokers or bankers, and they're not usually the best deals, right? Number one, I find that some of those folks, the brokers in particular, are not very well educated on what it is they're selling. So you really have to, it's more of a buyer beware, and you have to really dig in to understand what it is you're getting, because I've found that the brokers and some of these smaller banker types really don't understand what it is that they're selling. It's more like they're pushing product more than anything else.
Right.
So I haven't found a lot of quality there, but at the same time, we have done deals that are good, right? You just have to your point, if you don't do your diligence and really understand what it is you're buying, it could be dangerous, and that's where you can't take what a banker or a broker says at face value in regards to the quality of the deal, because even stuff that maybe is a proprietary deal that you find on your own still may not be a high quality deal, right? You have to vet it and make sure you understand it and turn over every stone. So I think there's opportunities to find good deals in all those channels, and no matter what the channel is, at the end of the day, it's the team that's responsible for doing the diligence, and you shouldn't rely too heavily on the people bringing you the deals, especially even partners. There was a deal we had done in the technology space where a reputable, we had done a seed stage deal. It was a technology deal overseas. We had done a seed stage investment with them, and we had quite a few questions about the business and where they were. And then 6 months later, the company brought in a reputable venture capital firm here in the U.S., based up in Boston. Smart guys, understand the technology space, and we relied on their diligence to decide whether or not we wanted to do a follow-on investment, because we had a lot of questions. We had issues with the management team. And these guys came in, and they looked at it, and they gave it their stamp of approval. And that was good enough for us, because we're like, well, they must see something that we don't see, because they've done this. They're in the space. They do it every single day. 2 months later, they're scratching their heads, saying, "What in the world did we get involved in?" So there's a very important lesson learned. Even though you think you're bringing in a partner who you think is an expert, you still have to do your homework on it, because even they can miss something for whatever reason.
Right. So, yeah, I think that's probably the most valuable thing I've gotten out of this interview, and most valuable potentially for all the family offices listening, because so many of them just look for a co-investment opportunity where they can ride along on the coattails of an expert in the space and a strategic, investor partner, and that way they don't have to do their homework, as thoroughly. So I think that's a good warning for those family offices that are looking for kind of the easy way out without building out any due diligence team or resources at all.
No, it's true. I mean, the one advantage of having a partner like that, and believe it or not, it's worked out well, because they're so entrenched in what it is they do and are so well connected with strategic partners out there, or various other technology firms that they've done business with in the past, where they've sold off businesses to these guys. We've been able to make the corrections needed there in regards to management, in regards to the technology itself and what direction should go in, and also being able to bring in smart strategic partners to push the business forward. So that was the advantage of having them, but gee, it could have went the other way. So you absolutely have to do your homework, and you can't rely 100% on others.
Right. Yeah, that's the thing about direct investing. It's sometimes not about getting a 9% versus 12% return. It's getting a return versus losing all of your money in some cases. So a little bit different.
Exactly.
Than some things. Yeah. Okay. Well, I just have two more questions. So we're just about to wrap it up here.
Okay.
One question I had is just about meeting other large single-family offices. $300 million, billion-dollar-plus single-family offices. For those executives listening here, do you have any insights or just experience in, the last 10 years, where do you get to meet some of your peers? Like, what's your best advice for the people looking to network?
Well, I mean, not that I'm not here to give a plug to what you do, but I think, conferences such as yours, I think are, a good place to start, where you can meet a lot of family offices, in particular conferences that are focusing just in specific areas, whether it be, direct investing, because then you're going to find, like-minded folks that you can talk with, exchange ideas with, and hopefully potentially partner with.
Right.
What also is starting to happen is, some boutique-type firms are surfacing. There's one in Chicago, for example, where it was a family who had sold their very successful family business and had started an investment/merchant bank, where they have a big focus on looking at other single-family offices and, running conferences themselves in hopes of, having a business that they're out there marketing that a family office might be interested in meeting. And I find that's also a very interesting type venue to meet other like-minded folks to partner up with. But I also think that for the family offices, they also shouldn't lose sight of, going to traditional institutional gatherings within whatever sector it is they have an interest. Because, number one, they may run into another family office that has like interests and wants to invest capital in that area. But two, just keeping up to speed on what's changing within venture capital or private equity. For example, on the venture side, I've been going to various conferences that are purely institutional firms that are attending these things, and you learn how the industry's changed. And, for example, without getting into detail, when I did venture back in 1998 to 2002, Series A meant one thing. Today, a Series A round is very, very different from what it was in 1998. And, it's more of what they call today a seed or a traction round. So understanding how the dynamics of the industry has changed, I think, would also be very beneficial to a family office, so that when they are out there sourcing deals, they can sound like they know what they're doing, and they understand who to approach for, a particular phase that their particular business is in, maybe one that they've invested in, or one that they're looking to invest in and want to bring in other partners to co-invest alongside them.
Sure, that makes sense. And yeah, I went through most of the questions. Just had to skip over one or two here for time's sake. And so I wanted to see if there's any other advice or insights you wanted to leave with today, maybe something that you wanted to mention, but I didn't have time to ask you about. Was there anything else you wanted to add in?
I think, for folks that are looking to get into the space, I think they really need to be honest with themselves as a single-family office on what it is they want to do, how much time they want to commit to the initiative, number one, because it does take time, whether it's a $5 million equity check or a $100 million equity check. It's going to take time to help grow the business, help build the business. That's number one. Number two, they should be honest when assessing themselves and the skills that they have in-house and how they can use those skills to benefit whatever company it is they're going to acquire. I mean, for example, let's say you were an entrepreneur and you in a certain vertical and you sold your business 10 or 15 years ago and you're looking to get back into it because you had developed an area of expertise. The question you need to ask for yourself is, how relevant is that experience that I had 10 or 15 years ago today? Right? What's changed? Do I still have the same access and Rolodex that I did before as far as helping bring in new management and making the various connections on, whether it be sales channels or other things that the business might need? And I think it's important to understand where you are today versus where you were 10 years ago on the skill set and the value you can bring to the table. Doesn't mean there's no value to be brought to the table. It's just you have to understand, what are the limits of what it is I can bring today. And you just augment that. It doesn't mean don't do it. It just means understand where it is and realize that you may have to augment that skill going down the road as you get more active in the space and acquire businesses.
Right. Okay. Great. Yeah, well, thanks for sharing that. We have a lot of families that we're connected to who are kind of in that space right now, trying to get deals done. They've got a portfolio of maybe 2 or 3 businesses. They would like it to be 10 businesses, but they're just kind of navigating all those questions you just surfaced about, being diversified or just focusing on the business in the industry that they sold, 5-7 years ago, et cetera. So I think that a lot of people listening to this, if they operate a single-family office that's on the larger side, will definitely relate to a lot of the things that you've brought up, and in some cases they'll be frustrated because their families don't want to talk about it and they're not being honest about it. But hopefully in some cases they can kind of surface these conversations and just help kind of point the ship in the right direction or figure out what direction they even want to go in.
Right.
Great. Well, thanks for all your time today, Michael. Appreciate the thoughts, and appreciate you speaking at our single family office summit and just being a resource to our firm overall. And I hope that everyone enjoyed this interview. And if anybody would like to get in touch with Michael, just let me know. I'd be happy to connect the two of you. And I hope everyone found this useful.
Okay. Well, thank you. I appreciate it. As always, I enjoy the conversation.
Great. Thanks, Mike.
Thank you for listening to this edition of the Family Office Podcast, powered by FamilyOffices.com.